What's up, you guys? It's Graham here. So I gotta talk about something that no one seems to be addressing, yet it's happening right now. For some reason, it's entirely overlooked, and when you hear about this, it should really make you question exactly what you're invested in and why. Because throughout the last 6 months, it was found that companies have been selling off their own shares at record levels, diluting your investment and leaving you holding the bag in the event the price falls. In fact, throughout the last 12 months, almost 750 money-losing firms have sold shares in the secondary market, noting that both times this has happened in the past, the market was overheated and started to decline. Or in other words, if you're a company and you believe your stock price is overvalued, you could sell more shares at the expense of existing investors, you could raise a lot of money with very little downside, and even if the stock price ends up dropping, it doesn't matter because now you've got cash on hand that you could use for growth, expansion, or even buying back the same stock that you sold at an even lower price at some point in the future. So let's talk about exactly what's happening, the concern for you as an investor, what this means for the overall market, why you should not ignore this, and then finally, my own thoughts about what's going on, because this is something that I've wanted to talk about for a while, and it's long overdue. Although before we go into that, it would help me out tremendously if you sold and took some profits on that like button by smashing it for the YouTube algorithm. All it takes is a gentle tap, it's totally free, and best of all, if we could get this video to 69,420 likes, I will introduce my next video with whatever the top comment of this video says. So thank you guys so much, and now let's begin. Alright, so all of this starts with what's known as selling stocks and share dilution. This is the practice where businesses issue more stock on the market for sale in an effort to raise money at their current share price. For a company, this could be good because it means they'll receive more working capital that they could then invest back into the business. But this is often done at the expense of you as the investor because now your shares own just a little bit less than they did before. For example, let's just say that my new coffee company, now for sale at BankrollCoffee.com, went public and we sold 50% of our ownership through 50 shares at $1 each. And now in return, we have an extra $50 at our disposal to reinvest back into the business and eventually come out with a T. But then the unthinkable happens. All of a sudden, the stock market goes crazy, and within a few months, our shares are now trading at $100 each. Well, if we believe our share price is overvalued, or we're uncertain about our future, or if we need the money to reinvest, or if we just really want to use that money to go and buy a brand new mega yacht, we could issue another 50 shares, raise $500 with almost no downside to ourselves, and then voila, we now have an extra cash buffer to use for anything. However, now the shares that you own as an investor are worth a little bit less. Because before the share offering, every one share was equal to 1% ownership in the company. But since we doubled the existing shares in the market, now every one share is equivalent to 0.5% ownership, thereby diluting the amount that you have as an investor. Now, in theory, this doesn't matter so much if the price of the stock continues going up and maybe one day it's trading at $150. Although that still doesn't excuse the fact that you now own a little bit less than you did before, and the company gets to retain that extra money regardless of what happens. The concern though at this point is that a company could simply be raising money right now at investor expense, cashing in on record high stock prices and market euphoria, paying themselves exorbitant salaries, and subsequently not providing an equivalent value back to the shareholders, even though the investors are the ones taking on all the risk. For example, in February of 2021, Carnival Cruise Lines announced that they would be offering $1 billion worth of stock with the intention of using it for general business purposes. They say those funds were necessary with no revenue coming in, but hundreds of millions of dollars going out each month. And if you're wondering how much they're spending, it's $600 million every month with a loss of over $2.2 billion last quarter. Now, that move diluted existing shareholders by 4%, yet shares rallied 6% following the news because now the company has more cash on hand to use towards those expenses. However, just a few months later, Carnival Cruise Lines announced again that it may sell up to $500 million in stock from time to time as part of an at-the-money equity offering program. And with that, the stock's price instantly slid about 7%, while the company's outlook doesn't exactly look promising and existing shares are even further diluted. Tesla was also very quick to take advantage of this in December of 2020, right before their stock price was about to hit a record high, when they announced that they would begin to sell up to $5 billion worth of stock from time to time. Tesla said the money would be used to expand the Model Y production capacity at the Gigafactory in Shanghai and construction of similar factories in Berlin and Texas. But in the process, Bloomberg reports that they've diluted existing shareholders by 17%. Now, another example is a really popular one, and that would be GameStop. After nearly filing for bankruptcy, their company was saved by the Wall Street Bets movement, who bought the stock, squeezed short sellers, and sent the price skyrocketing from a low of $4 to a high of $483 in what may very well be their short squeeze of the decade. GameStop saw this, and in April, they sold 3.5 million shares shares into the market at an average price of $157 each, raising $551 million in the process. This gave them additional cash on hand that would allow them to segue into e-commerce and would ultimately save them from bankruptcy. Then from there, as their stock continued to rally, they sold an additional 5 million shares and raised another $1.13 billion of cash for the company. They announced that they would be using net proceeds from the offering to invest in growth initiatives and maintain a strong balance sheet. And in response to that, the stock price continued going higher. Now the company is completely debt-free, they have a ton of cash on hand, and they're in a really strong position to move forward, all thanks to the shareholders who bought the stock and took a 7% dilution in the process. AMC is also another recent example who did the exact same thing. Now, right before the whole meme stock explosion, AMC announced that they had plans to sell 50 million additional shares as a way to raise $125 million and stave off bankruptcy. But then just weeks later, their stock price soared, and in the process, they wound up raising $917 million. And more recently, as the share price continued going up, they said that they completed another share offering at an average price of $50.85 each, giving them an additional $583 million. In total, they recently raised $1.2 billion, they strengthened their balance sheet, and that gives them a lot of flexibility to respond to any future challenges. Now, some have questioned this given that AMC executives have been selling off their stock as the price continues to rise, while others believe that, hey, it's normal. $8 million is a drop in the bucket, and they deserve to make some money from this. Now, on top of that, Microvision is yet another company looking to cash in, announcing that they would be selling $140 million worth of their stock during a time where their share price is up 1,270% year over year. And lastly, Virgin Galactic also recently filed registration that would allow them to sell up to $1 billion worth of stock during a time where, you guessed it, their stock price is near an all-time high. In response to this, they said that historically we've looked to take advantage of favorable market conditions to raise capital for the business, and they're not alone. Like I mentioned, in the last 12 months, almost 750 money-losing firms have sold shares in the secondary market in an effort to cash in on high prices, and that now is a time to be made aware of what's going on. Now here's the thing, even though this all sounds like FUD, doom and gloom, selling shares like this and raising money isn't always inherently a bad thing. And before we go into talk about all the potential issues, we gotta talk about the benefits. First, by doing this, a struggling company would be able to raise money at a price they ordinarily would have never achieved. It's no surprise that GameStop is a perfect example of this. Their rallying stock price allowed them to issue more shares, pay off all of their debt, and earn over $1 billion worth of cash in the process. That absolutely saved the company from bankruptcy, it opened up so many new opportunities, and now they have an actual shot at being a game-changing player in the entire industry. Pun intended. The second, other companies are able to take advantage of rising stock prices. Even if they don't need the money right now, at their core, they're still a business, and having more cash on hand gives them more leverage and flexibility with very little cost to themselves. Now, yes, it does dilute the shareholder, but having more cash on hand puts them in a stronger position as a company in the long run. The third, they might be able to use that cash to then go and acquire new businesses or find other ways of making money. For example, even if a company dilutes their shareholders by 10%, maybe they could reuse that money somewhere else that winds up doubling their profits. And now, even though you own less of the company, that smaller portion is now more valuable because they've expanded into new ventures. Except in this case, you are the one lending them money, and they're the ones that you're trusting to provide you with an equivalent return. But of course, as with anything, there are some downsides with this. First, like I mentioned, you now own a little bit less than you did previously. Because of that, the company now needs to make more money, or its price needs to go up for you to make a profit. Otherwise, you wind up owning a smaller piece of the pie along with smaller profits while the company raises money at your expense. The second, there's also no guarantee the company will use your money appropriately. Even though some companies have very clear intentions in terms of where and how they intend to use your money, and that could work out really well for you, other companies could simply be taking advantage of record high stock prices even though it hurts their investors in the process. And third, analysts warn that so many unprofitable companies issuing shares is a sign that perhaps points to companies getting greedy. They say that throughout both previous points where unprofitable firms dominated equity offerings, the stock market was either at the start of a bear market or already in one. Sundial Research, who were the ones that conducted this study, said that money-losing firms are flooding the secondary market adds to a growing set of signs that points to elevated enthusiasm. Plus, when there's increased appetite for issues from unprofitable companies, it tends to mark a point of euphoria. So is this actually something that you should be concerned about, or is this just another article full of nonsense FUD trying to get you to buy their premium subscription for $340? $40 a year. First of all, it makes sense that unprofitable companies would be more likely to sell stock, increase dilution, and raise cash. Those companies are in a fundamentally different financial position, and if they want to grow, expand, or even survive, then share dilution could be the best option. They'll give retail investors the option to buy in, they'll be able to hopefully use that cash to turn their business around, and it could be a win-win scenario for everybody. It also makes sense that companies would do this when they believe their share price is at a market high, or they believe they would best be able to capitalize on market momentum. Remember, at their core, these aren't just stonks that we could swing trade for fun. These are real cash-flowing businesses that need to make the best choice for the company. If they see their stock growing at 1,200% year over year, I think it's reasonable to expect that they would want to cash in on some of that and put themselves in a better financial position. Now sure, it does come at the upfront expense of the investor, but if you invest in a company, you should want them to fundamentally do well long term, and this puts them in the best position to do so. However, the downside is that with almost 750 unprofitable companies cashing in, it's inevitable that not all of them are going to have the best intentions and might wind up abusing investor money. There's nothing that says a company can't go and issue more shares at a market high, cash in a whole bunch of money, pay themselves big bonuses, and do all of that at the expense of you. So it's more important than ever to understand exactly which companies you're invested in and figure out exactly why they need the money to begin with. If it is for future growth, expansion, or acquisition, then I do think it can be a good thing. But if it's merely because the stock is at an all-time high and it's an easy cash grab, then at least that's something that you should be made aware of and vigilant of. The second, we should also address the surge of unprofitable companies cashing in and issuing new shares throughout the last 18 months. And again, to me, this is not all that surprising. During the lockdown, so many businesses took a pretty significant hit, and it makes sense that a larger portion than normal would temporarily see losses while their businesses are shut down. Now that does not mean that they're fundamentally unprofitable or that they have a bad business model, but they may have experienced temporary losses and want to use this as a bridge to get themselves ahead. Now sure, it does help that share prices have largely recovered, but that doesn't mean that all of these companies are the same unprofitable ones that existed back in 2000 or 2009. That's why I believe that even though this has historically happened right before a crash, we don't know the true metrics behind how much of this is just transitionary. So this is something to certainly keep an eye on, but it's nothing to me that screams the market is about to come crashing down. At the end of the day, it's really up to the individual company to put that cash to its best use and not take advantage of retail enthusiasm that just buys whatever they can. It's not always bad when a company wants to raise money, especially during a time like this, but it is what they do with that money that ends up mattering. And if you invest in a company, you really have to hold that conviction that they're not just going to go and pay themselves bonuses, but instead grow your piece of the pie, make you more money, and hopefully, if I ask really nicely, you smash the like button for the YouTube algorithm. So with that said, you guys, thank you so much for watching. I really appreciate it. As always, make sure to destroy the subscribe button and the notification bell. Also, feel free to add me on Instagram. I post it pretty much daily, so if you want to be a part of it there, feel free to add me there. As on my second channel, The Graham Stephan Show, I post there every single day. I'm not posting here. So if you want to see a brand new video from me every single day, make sure to add yourself to that. And lastly, if you want a totally free stock, now worth all the way up to $70, use the link down below in the description. And plus, when you deposit $100 on the platform using the code GRAHAM, you'll be entered for a free chance to win a totally free stock of Tesla. The deadline to do that is July 12th. So thank you guys so much. Good luck. Thank you so much for watching, and until next time.